So we'll now begin with the discussion on multi-factor models. So a multi-factor model is an extension of a one-factor market model like the CAPM or the capital allocation line, wherein the one factor was the return on the market or the market risk premium. In a multi-factor model, asset returns are a function of more than one factor. There are three broad types of multi-factor models. Macroeconomic factor models assume that the returns are explained by surprises or shocks in the macroeconomic risk factors. So if GDP underperforms or outperforms, similarly if interest rates go up or down by more or less than expected, if inflation is more or less than expected, then that will cause a deviation from the expected return. Factor surprises are defined as the difference between the realized value and its consensus expected value. So according to the market or according to the macroeconomic factor, the return on the portfolio is equal to the expected return plus beta 1 times the surprise on GDP plus beta 2 times the surprise on interest rates plus beta 3 times the surprise on inflation, so on and so forth. If there is no surprise on any front, then the return will be given as the expected return. So the constant in the macroeconomic factor model, remember, is the expected return in the absence of any surprises. Compute the stock return using a macroeconomic factor model. The following two-factor model is used to explain the returns from Simtech. The returns are given as the expected return plus the sensitivities. The expected return equals 14%. Over the past year, GDP grew at a rate that was 4 percentage points higher than originally expected. So the surprise on the GDP has been 4%. The surprise on the quality spread was a negative 2%. So spread was 2 percentage points lower than originally expected. So it was minus 2. Sensitivity to the GDP rate factor is 3 and sensitivity to the quality factor is minus 0.4. So as the spread decreases, the return increases. As the spread increases, the return decreases. Over the past year, SE also experienced a 1% company unique surprise. So the unique surprise, please note, gets added in the macroeconomic factors. There are factor returns and there is idiosyncratic risk as always. So that is given to be 1%. Construct the macroeconomic factor model for SU and calculate its return for the year. So it will be 14%, that is the expected return. Very important to remember, in the macroeconomic model, the constant is the expected return, not the risk-free rate, as will be the case in many other models. Plus 3 into 4% plus minus 0.4 into minus 2 plus 1%. Which comes out to be 27.8%. So please understand, in the macroeconomic factor, generally our sensitivities or generally our factors would be macroeconomic variables. Return on the market could also have been one of the variables. However, the factor itself is the surprise, if any, on that variable, and the sensitivities are the sensitivities to that surprise. In this case, it comes out to be 27.8%. Fundamental factor models, as the second category, assume asset returns are not dependent so much on macro variables, rather they are explained by the returns from multiple firm-specific factors. So the PE ratio of the company, the market cap of the company, the leverage ratio, earnings growth, etc., depend or decide the return that that company will give. So once again, the return is equal to alpha, that is a constant, plus beta times the return associated with the PE factor plus beta 2 times the return associated with the size factor. A is the intercept term. Please note the sensitivities here are standardized sensitivity. So the factor return, which was variable in the macroeconomic model, has now been fixed. That is, low P by E firms outperform high P by E firms by, let's say, some 2% or 3%. So that is what we'll fix as the return associated with the P factor. Similarly, we've seen that smaller companies outperform bigger companies by, let's say, 4%. So this is the standardized return related to size. Now, before I apply a 3% return associated with the PE factor, I will first have to decide whether my company is a small company or not. We made a general statement that 3% is the additional return that small companies give over, or rather 4% is that small companies give over big companies. 3% is what low P by E companies give over and above high P by E companies. Now, before I can apply this factor or any of these factors to my company, I will have to decide whether my company is a low P by E company or a high P by E company, because if it is a standard company, then this B1 must be 0. If it's a standard company, there is no small size or big size, it's an average size, then this factor sensitivity should be 0. So P by E is the return associated with the P by E factor. Something like, on an average, small companies outperform bigger companies by so much. The factor sensitivity is the standardized sensitivity, will tell me whether my company actually is a small company or a big company. If it is a big company, probably this has to be negative, because it will give a lower return. Similarly with the PE ratio. So the standardized sensitivity of the stock to the PE multiple is defined as the PE ratio for the stock minus the average P by E calculated across all stocks, standard deviation of the P by E across all stocks. So if the PE ratio of my company is higher, then the standardized would be greater than 1. If the PE multiple of my company is lower, then the standardized ratio will be less than 0. The return associated with this factor will probably be negative. That is, high P by E companies will give a lower return, low P by E companies will give a higher return. In the fundamental factor model, we say that the return is not, or the assumption is that the return is not linked with macroeconomic variables. The return is linked with company specific variables. First step is to standardize our company specific variables. That is our company a higher P by E company or a lower P by E company? If it is an average company, then this will be 0. Is our company a higher sized company or a lower size company? Simply it will be the size of our company minus the average size of the market divided by the standard deviation in the size, that will be the standardized size beta. Again, if our size is the same as average, then this difference will be 0. FE by E is the return associated with the PE. So if our PE is lower or if our PE is higher, then we see there is some possibility of a higher or a lower return, and that is captured in the factor return. Similarly, whether our size is higher or lower is captured in the return to size. We'll explain this better with the help of an example when we do a question. Please note, the alpha in a fundamental factor model has no interpretive significance. So just like we said that the alpha in the macroeconomic model is the expected return in the absence of any surprises, the alpha in the fundamental factor model per se does not imply an expected return or anything like. It is just the alpha or the constant that comes from the regression equation. So to make this regression or to equate these returns to the factor returns as we are projecting, this is the alpha that comes from the regression, that is B0 minus B1 into X bar. The P for a stock is 18 The average PE for all stocks is 14 and the standard deviation of the PE ratios is 15. Calculate the standardized beta of stock I to the PE factor. So standardized beta would be the PE for our stock minus the PE for all stocks, that is 14, divided by the standard deviation of PE, that is 5. So it will be 4 upon 5, that is 0.8. The return to the PE factor is minus 4%. That is, to every extent that your PE is one standard deviation above, your return is likely to be lower by 4%. So in our case, we are 0.8 standard deviations above the average for the market. So our expected return is 0.8 into minus 4, that is 3% lower as compared to a stock with an average P by E. If our P by E was lower, if this was 12, this multiplication would have become positive, our return would have been higher. So this is the fundamental factor model under its set of assumptions. It may or may not be correct. Similarly, with the macroeconomic model, we have just explained the model. There is no proof that we have given for the macroeconomic model like we did for the capital asset pricing model or the capital allocation model. So these are just different theories and different models. They may work in a particular situation, they may not work. The macroeconomic model says that returns are dependent on macroeconomic factors. Fundamental factor model says that the returns are dependent on firm specific factors like the PE ratio or the size of the firm. Consider a portfolio allocated 60% to hotel and 40% to salon. Compute the expected returns for the portfolio given the following macroeconomic factor model returns. So return on the hotel is 0.15 into 1.6 into F1 plus 0.7 into F2, so on and so forth. Please note, in the multi-factor model, the constant term represents the expected return in the absence of any surprises. So since the question also asks us the expected return on the portfolio, we don't need the returns on the factors. A very good way to confuse you in this question would be to also give you the surprises on the factors. If the question is only asking the expected return for the portfolio, then we will assume there were no surprises, or in the absence of surprises, the return on hotel would be 15% and the return on salon would be 6%. If we are 60% in hotel and 40% in salon, then our return can simply be calculated as 0.6 into 15 plus 0.4 into 6, that is 11.4%. The third category of models is referred to as the statistical factor models. So statistical models use multivariate statistics to identify statistical factors that explain the covariation amongst asset returns. So in statistical models, the coefficients or the factors could be macroeconomic variables, could be fundamental variable, could be any other variable, whatever mathematically best fits our historical returns. So whatever set of factors best explain historical returns is what will be included. If we so find that the return on the Indian market is very highly correlated with rainfall in New York, then rainfall in New York will also be a factor in the statistical factor model, because this is pure maths. The problem is that they do not lend themselves well to economic interpretation. For example, there is no logical reason why returns on an Indian market will be correlated or will be dependent on the rainfall in New York. However, statistical models ignore all that and they just try to find statistically what variables have best explained the returns, even though there may at times be no economic correlation. Now, a very important multi-factor model is given by the arbitrage pricing theory. Rather, it's not given, but is explained by the arbitrage pricing theory. Now, the problem that we need the reason that we need the arbitrage pricing theory is because of the extremely limiting set of assumptions under which we derived the CAPM and the securities market line. So, we assumed perfect markets, we assumed infinite borrowing and lending at the risk-free rate, we assumed all people have the same expectations, so on and so forth. A lot of things which will never be true in the real markets. Everybody will always not have the same expectations. The arbitrage pricing theory does not need any assumptions of the CAPM or the capital market theory. So we don't need perfect markets, we don't need same expectations, we don't need same investment horizon. None of the assumptions that we needed there are needed under this theory. So that's the basic advantage. The APT has some assumptions though which are a lot less limiting as compared to the CAPM assumptions. So APT assumes that first returns are derived from a multi-factor model. Return on the market may be one factor in that multi-factor model, but there are other factors also that drive returns of stocks. Unfortunately, the model provides little guidance for the identification of those risk factors. This is one of the major weaknesses of the arbitrage pricing theory, that it doesn't tell us GDP growth or inflation or what is that risk factor. It just assumes that returns are derived from a multi-factor model. Unsystematic risk can be completely diversified away. This is similar to the assumption in CAPM, that is, unsystematic risk is not priced. And this is a fair assumption because we proved it ourselves also with the example of the fashion designer, that unsystematic risk does not need to be priced. It is not really a risk that the diversified investor is facing. The big assumption that arbitrage pricing theory makes, and is also a relatively logical assumption, that no arbitrage opportunities exist in the market. An arbitrage opportunity is defined as an opportunity that bears no risk, no cost, and yet provides a profit. So the assumption basically is that investors will undertake infinitely large positions to make infinite profit if an arbitrage opportunity exists, and hence that arbitrage opportunity cannot exist forever. So if it is a long short opportunity, then again people will take corresponding positions so that the opportunity dissipates. Again, not a very limiting assumption. So all assumptions in arbitrage pricing theory are much less restrictive as the assumptions of CAPM. We're just saying that returns come from a multi-factor model, unsystematic risk can be diversified away, and that no arbitrage opportunities exist. The reason this is important is that let's assume we derived our multi-factor model and we said that the return on stock A is equal to the risk-free rate plus beta times the return on the market, beta times the GDP growth, and beta 3 times the inflation. Then the model assumes that if any of these factors changes, the stock also must change or must react, otherwise there will be an arbitrage opportunity. So if GDP growth keeps going up but the stock doesn't move, such a situation will be exploited, and hence the returns will be in line with the factors. So that's the only assumption that the arbitrage pricing theory needs. So APT is an equilibrium asset pricing model which assumes no arbitrage opportunities exist. According to the arbitrage pricing theory, the return is linearly related to the factor sensitivities. So lambda stands for the expected risk premium associated with each risk factor, and beta is the sensitivity. So the expected return on the portfolio is equal to the risk-free rate. So you should at least get the risk-free rate plus beta times the risk premium attributable to factor 1. So if we are taking risk on GDP growth, then we should get so much additional return. If we are taking risk on the stock market, then we should get so much additional return. Sensitivities represent again how much of this risk are we taking. 1.2 indicates we are taking more market risk. 0.5 indicates we are taking a less market risk. So the arbitrage pricing theory says that the returns come from a multi-factor model and no arbitrage opportunities exist, such that if these factors change or if these factors give us excess return, then our stock will also react, otherwise there will be an arbitrage opportunity. So the expected return is RF plus beta times lambda 1, beta 2 times lambda 2, beta 3 times lambda 3, so on and so forth, where beta is the sensitivities, just like the beta in CAPM, and lambda is the risk premiums associated to various factors. Factor may not just be market now. Risk may come from GDP, may come from inflation, may come from any other factor. The weakness of APT is it does not give us guidance on how to derive those factors or what those factors are. An investment firm employs a two-factor APT model. The risk-free rate equals 6%. Determine the expected return for the invest fund using the following data. Factor betas are so much. Factor risk premiums are also given. So the return will be the risk-free rate plus I have assumed 1.2 units of risk corresponding to factor 1, for which every 1 unit I should get additional 5%. So if I am taking 1.2 units, I should get additional 6%. Similarly, 1.8 units I am taking of risk 2. Taking risk 2 should give me additional return over and above the risk-free rate of about 2%. If I am taking 1.8 units of risk, then this is the additional return that I must earn. Will give us the return from the arbitrage pricing model as equal to 15.6%. Please note, these factors in the arbitrage pricing theory are also macroeconomic factors generally, because the assumption is that idiosyncratic risk can be diversified away. So these will be factors that affect the whole market or cause a systemic loss. Assume your investment firm uses a single factor model to evaluate assets. Consider the following data for portfolios A, B and C. Expected return is given, beta is given. There is only one factor, so beta to that one factor. Return on portfolio B is given and the beta is given, and there is a portfolio C also given with an actual expected return and the risk. First, let's see if there is any arbitrage opportunity, and if yes, how will we exploit it? Now, let's assume that assets A and B are correctly priced. It's just an assumption. And using that assumption, let's calculate the risk-free rate and the factor risk premium given the sensitivities. So, the expected return on A will be RF plus 1.6 into lambda, that is the factor risk premium, which comes out to be equal to 15%. Assuming the asset is correctly priced. Similarly, for asset B, RF, that is the arbitrage pricing formula, plus beta into lambda 1, since there is only one factor, will be 2.2 into lambda, which will give us, or which will come out to be 20%. We'll call this equation 2, we'll call this equation 1. So assuming these are correctly priced, we can do 2 minus 1 and derive that 0.6 lambda is equal to 5%, or lambda comes out to be 5 upon 0.6, that is 8.33%. We can substitute 8.33 in any of these equations and derive RF. So RF will be 15 minus 1.6 into 8.33, or 20 minus 2.2 into 8.33, both will give the same answer as 1.67%. Using the values of RF and lambda, let's now try to calculate the return on asset C as given by the arbitrage portfolio, 3-year arbitrage pricing theory. So return on C from the APT will come out to be 1.67 plus 1.9 times lambda, that is 8.33, which comes out to be approximately 17.5%. So what we see is that corresponding to the risk that stock C is taking, the return is lower. So either C is overvalued, or if C is correctly valued, then A and B are undervalued, because either these are giving us lower return or C is giving us a correct return, or C is overvalued, that is the value or price of C should come down so as to give an expected return of 17.5%. Expected return is 17, rather the required return is 17.5%. Now to exploit this arbitrage, we can create a 1.9 beta portfolio by simply weighting A and B. So let's assume, let's put W in A, so that W into 1.6 plus 1 minus W into 2.2 is equal to 1.9. So let's compute W, or we can say that 2.2 minus 0.6 into W is equal to 1.9, or 0.6 into W is equal to 0.3, or W is equal to 1 by 2, that is 0.5. So if we take 50% of asset A and 50% of asset B, our risk will be the same as asset C, because our risk will become 1.9. And let's see what is the return that this portfolio is expected to give us. 0.5 into 15 plus 0.5 into 20, that is 10 plus 7.5, that is equal to 17.5. So we can long a 1.9 risk portfolio. So long $100 of worth of $50 in A and $50 in B. And we can short, to get this $100, we can simply short portfolio C, that is short $100 worth of C. Whatever happens, whatever may be the return of that factor, this portfolio, that is portfolio A and B, because the beta reaction will be the same, both have a beta of 1.9. The combination of portfolio A and B will give us 0.5% more than what we will lose in portfolio C. So we will gain 17.5%, and when we are shorting, we will lose, or we will have to pay 17%, giving us a return of 0.5%. So the arbitrage pricing theory says that this situation does not happen. Assets are priced consistently. So either A and B will go up in price so that their expected return will come down, or C will go down in price so that its expected return will go up to 17.5%. We'll study the concept of information ratio in a lot more detail in the coming two readings. However, active return is defined as the difference between the portfolio and the benchmark returns. So return on the portfolio minus the return on the benchmark is referred to as active return. Active risk is the standard deviation of the active return over time. So we can calculate the active returns for various years and then take the standard deviation of these active returns. That will be referred to as active risk or tracking error volatility. Active risk is determined by the manager's active factor tilt and active asset selection decisions. So active risk squared is equal to active factor risk plus active specific risk. Active factor risk is referred to or comes from sectoral deviations. Active specific risk comes from individual stock deviations as compared to the benchmark. Active risk comes, or rather active return comes, because our portfolio is different from the benchmark. If the portfolio was exactly the same as the benchmark, there would be no active return. So active return means we are deviating. We are deviating from the benchmark. Now we can deviate sectorally or we can deviate stock wise. Let's assume that our benchmark consists of 50% auto and 50% steel. Within auto, it consists 25% of auto A and 25% of auto company B. Steel, it consists of 25, the steel 50% is made up as 25% in steel company C and 25% in steel company B. If I also have 25% of A, B, C and D in my portfolio, will there be any active return? No, because whatever the benchmark gives, I will also give. Now I can deviate by either overweighting one sector and underweighting the other. So I put 70% in autos and 30% in steel. Within steel, I maintain the allocation. That is 15-15 I put in both, and here 35-35 I put in both. So there is no active specific risk, but what I've taken is an active factor risk because I have overweighted one sector and underweighted other. My call is the auto sector will outperform the steel sector. Which company I don't have a view on. I just feel that auto growth in India will be good. Yes, definitely good companies will take market share, but I don't have that view. So I'm not taking any stock specific view, I'm taking a sectoral view. Active specific risk purely would be when I keep the same 50-50 proportion in auto and steel. However, instead of 25-25, I put the entire 50 in stock A and I put the entire 50 in steel company D. So now there is no factor risk per se. Our sectoral deviation is not much, but our stock specific deviation is a lot more. So active risk squared is equal to active factor risk plus active specific risk. We'll do a few examples and understand them better. Information ratio is the active return divided by the active risk. Active risk is the historical standard deviation of the active return. Active return is the return over and above the benchmark. Consider two funds, organized fund and secure fund. The benchmark for both funds is Yorkshire 1000, a well-diversified stock index. Active factor risk for organized fund equals 40 and for secure funds equal 20. Active specific risk is 60 and 10. Contrast the two styles of portfolio management for the two funds. So organized fund is taking both types of calls. It's taking sectoral calls as well as stock calls. Whereas secure fund we see is not taking many stock calls. Its outperformance is coming, or its deviations are coming mainly from factor exposures or sectoral calls. Assume that the portfolio and the benchmark returns over the past 12 months have been shown in the following table. This is the return on the portfolio. This is the return on the benchmark. Return on the portfolio minus the return on the benchmark, please verify, will be the active return in any given month. Similarly, the active return in the second month, in the third month, so on and so forth. 0.01 minus 0.007 will be equal to 0.003. We are given the average of the active return and we are given the average of the benchmark return. Hence, we can compute the average active return as 0.003. Sample standard deviation, that is the standard deviation of the active returns, is also given to be 0.0052. Compute the information ratio, pretty straightforward. It will be the active return divided by the active risk, which will come out to be 0.0576 or 5.76%. The higher the information ratio, the more active return the management earned per unit of active risk. An information ratio of 0.06 indicates the manager earned about 6 basis points of active return per unit of active risk. Please note, in the previous formula that we studied, that is the active risk squared, or the variance of the active return, is equal to the active factor risk. Please note, the active factor risk is also the variance of the return attributable to sectoral deviations. And similarly, active sector or other active specific risk is also a variance. It is a variance of the returns attributable to stock picking or stock selection and not sectoral deviations. At level 3, we'll study in more detail how these calculations are done when we study portfolio attribution and equity valuation, etc. Many a times we construct factor portfolios. So a factor portfolio is a portfolio with a factor sensitivity of 1 to a particular factor and 0 to all other factors. So it's a useful portfolio. Let's say in my otherwise diversified portfolio, I want to increase exposure to GDP growth. Or from my current portfolio, I want to completely hedge the portion corresponding to GDP growth. The other factors I want to remain exposed to. I don't think GDP growth will act favorably, so I want to hedge against GDP growth. I can take help of these factor portfolios. I can long and short factor portfolios to increase or decrease the sensitivity of that particular factor in my portfolios. So if you long more of this factor portfolio, then in your overall portfolio, you will increase the allocation to this factor. If you short this factor portfolio, then you will reduce the allocation to this factor from your portfolios. So factor portfolios have a sensitivity of 1 to a particular factor and 0 to all other factors, often useful to manipulate our allocations and our sensitivities in the context of portfolio management. Tracking portfolio, on the other hand, has a specific set of factor sensitivities that replicate the exposures of a benchmark or of an index. So this portfolio has been designed to replicate the factor sensitivities of some other benchmark portfolio. So as the factors change, GDP surprises or interest rates change or inflation change, the benchmark as well as this tracking portfolio will more or less change by the same extent. So if you want to just track a benchmark, you can also use the tracking portfolio. Again, regression analysis can be used to compute the sensitivities of the benchmark to various factors, and then in your portfolio also have the same sensitivities. The last slide on portfolio concepts tries to tell us the differences between capital asset pricing model and the arbitrage pricing theory. So CAPM is a single factor asset pricing model in which only risk is the risk relative to the broad market. So CAPM suggests all investors should hold some combination of the market portfolio and the risk-free asset. In contrast, the APT captures multiple dimensions of risk besides the overall market risk and suggests that investors make decisions relative to multiple sources of risk, not just market risk. Liquidity, GDP growth, etc. may also be considerations that should be factored in. Investors who are independently wealthy and don't depend on their salary as a source of income can earn a substantial risk premium by increasing their portfolio allocation to cyclical stocks, even though they are exposed to less than average systematic recession risk. Now, cyclical stocks generally are more volatile and they do present the possibility of a big loss. However, big gains also come. For an investor who is generally not independently wealthy, will try to avoid such stocks because there is a risk that these stocks may underperform greatly or there may be a big loss. So what the theory says is that if a lot of people are avoiding these stocks because of this reason, because of the potential of some downside or some big downside, then investing in them may be giving you an enhanced risk premium, because there is a risk premium coming not because of market risk but because of the cyclicality and low volatility, and because people in general don't want to take risks or don't want to enter into cyclical stocks. So if you are not concerned about your wealth going down for a short period in time because you're not dependent on salary or you're independently wealthy, then you may be able to exploit such opportunities and earn an enhanced risk premium. So basically some arbitrage opportunities he's saying may come, that is, assets may be inefficiently priced for technical reasons because people don't want to invest in them. So that was about the review of reading number 57, that is reading on portfolio concepts. So an important reading, a detailed and a big reading, one of the biggest readings of the curriculum. So make sure you practice a lot of questions and you understand the concepts.